Greetings, everyone. This is third module and the last module for our training introduction to options contract. Till now, in previous two modules, we have covered the basics of options, what are call options, put options, what is option moneyness, what is option payoff profile. In this very module, we are going to touch upon some option strategies which you can use either to hedge your portfolio or to take speculative position in the market. The first one is covered call. As the name implies, you are covering a certain call option. That means you already own the asset and you are writing a call option, right? So you own a particular asset, and then when you write a call option, you receive option premium. The problem here is if this contract becomes in the money, that means for the buyer of this option, if this option becomes profitable, then if this is a delivery based option, you have to deliver these shares to him. And if this is not a delivery based option, then you will experience an opportunity loss. Let's look at the payoff diagram and I'll cover these aspects there. This is your stock position. Okay. And you have, let's say it is at 100, and this is the strike price at which you have sold a call option for which you received 5 dirhams as premium. Now, what is going to happen is if this stock starts going up till 110, you are in gain, because in your actual position you are making a profit of 10 plus you received a premium of 5, so you made an actual profit of 15. But beyond this level, if stock keeps on going up, no benefit is going to accrue to you. Why? Because here in this case, your option will start generating losses for you. At 115, for example, your option buyer is profitable by 5. So that means that profit is taken away from you. Now you are left with only 10. That's your profit on your actual stock position. So your upside is limited, but your downside is unlimited. But thanks to the premium you received, you have a buffer of 5. That means if the stock actually goes up to 95, you have actually made no losses, because in your actual stock position, you are sitting at a negative 5, but you also received a premium of 5. So no profit, no loss. Beyond 95, if it goes down, yes, you are going to make losses. So the higher the exercise price you choose, less premium you are going to receive, but there will be more leeway for the upside. So this strategy is definitely not recommended in a strong bull market, because if you do this in a bull market where everything is going up, you are going to underperform rather than just holding a stock. So it's better to just hold a stock, do not sell the option. But in the bear market, the covered call writer will outperform. Why? Because you received extra 5 dirham for your call premium. Protective put is another strategy. Here, you're buying a put option so that if the stock goes down, your put option becomes profitable. So whatever losses you are going to generate in your actual stock position, those losses will be negated by your put option. It you can think of it like an insurance policy, as simple as that, right? So you're buying an insurance policy. If the stock goes up, you are going to reap the benefits, but if it goes down, you only are going to bear certain losses, not beyond a certain loss. Okay. So let's look at this option here. Let's say you have purchased a put option. Okay. This is at strike 100. Okay. So stock is sitting at 100. At strike 100, you have purchased a put option and you have paid 5 dirham for this put option. So now what is going to happen if stock goes to 120, correct? You are going to make 20 dirham in your stock position minus the 5 dirham premium you paid for buying the put option. So you are making 15. If it goes to 150, so it will be 50 minus 5, 45. So you see your profit potential is still unlimited. But what about your loss potential? So if it goes down, you are protected. Why you are protected? Because you purchase a put option at 100. So if it goes to 20, In a normal condition, you would have suffered a loss of 80 from 100 to 20, correct? But since you have purchased a put option, this put option would have become profitable by 80, cancelling out all your losses in your actual stock position. So the maximum loss you can suffer is just the amount of premium which you have paid. So question, in a covered call, maximum profit is unlimited. The answer is no. Because if you look at covered call, our maximum is limited, right? Okay, third strategy, bull spread. So a bull spread becomes more valuable with an increase in price. That is why bull. Bull market means something which is going up, correct? So what you are going to do is, you are going to buy one option and then you are going to write another option with a higher strike price. What you are going for is limited maximum gain and limited maximum loss. So let's look at this. So you purchased an option at 100 and let's say you paid 10 dirham premium for it, and then you sold an option at 110 and let's say you received 5 dirham premium for it. So ultimately your total outlay is 5 dirham, correct? So now if this stock goes down below 100, your maximum loss is limited to the amount of your spread, that is the premium, net premium which you have paid. If it goes from 100 to 110, that means this option will become profitable by 10. But this option for the buyer who purchased this option from you, for him it is worthless, right? So ultimately you made a profit of 10 minus the cost of your spread, you made a profit of 5. Beyond this, let's take 120. On this contract, you made a profit of 20. On this contract where you sold the call option, you made a loss of 10. So your net profit is 10 minus the premium you paid. So ultimately your profit remains 5. So you see, you're going for limited upside, that is maximum profit you can make is 5. Maximum loss you can have is also 5. A bear spread becomes more valuable with a decrease in the price. As the name implies, bear spread, right? Bear means bearish, when you expect something to go down. This spread involves buying one option and then writing another one with a lower strike price, just the opposite of the previous one. So here, you purchased an option at 100. So you bought a put option at 100 and then you sold a call option at 90, correct? So for 100, you paid 10. For writing a call option at 90, you received 5. So what is your net expenditure on the premium? Negative 5. But you are expecting prices to go down. So let's say prices went down from 100 to 90. So if this happened, in this contract, you made a profit of 10. In this contract, it is worthless. So no profit, no loss for the buyer. He will let it expire worthless. So your overall profit is 10 minus 5 dirham which you paid for the spread. So your overall profit is 5, correct? What if prices start going down or start going up? If prices start going up, both these options will become worthless. But since you have paid a net premium of 5, that is going to be your maximum loss. So you see, you're going again for a limited profit, limited loss scenario. So your bull spread is much more applicable in a scenario where you're expecting a small rise in the underlying asset, not a huge jump, not a drop, just a small increment in your underlying assets price. And this bear spread is much more relevant for a market where you are expecting prices to go down a little bit. Not too much, just a little bit is fine. Even if it goes too much, your profit is fixed at 5 only. Okay. So in summary, a covered call is a position in which you own the particular asset and you sell a call, you receive premium for it. A protective put is the simultaneous holding of the asset and buying a put option on that asset. This put option will work like an insurance policy. So you are going to enjoy the upside, but your downside is now limited to the premium you paid for this option. A bull spread becomes more valuable with an increase in price, but a small increase. A bear spread becomes profitable with decrease in price with a small decrease. So this is the end of this training. I hope you enjoyed this training and hope to see you in other trainings as well.